Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello, my name is Lucas Deporbe, and I'm pleased to be joined today by co-portfolio managers for the Fidelity Global Future Leaders Fund, James Abella and Maroon Yunus. Welcome,
Hello.
gents.
Thank you. Hello.
Thank you.
Now, it's a very timely period at the moment to do a podcast because obviously there's a lot happening in markets, and one of the key things a lot of people are really focused on is the volatility in markets. We've seen, obviously, that spike up quite aggressively, and there's different reactions to volatility. If you think about behavioral investing and so forth, there's people that will sort of be very sort of conservative and maybe take money off the market. There's other people that will buy into the market, and there's people sort of, I guess, paralyzed by the market. Now, both of you are very experienced investors. How are you navigating this volatile period?
Yeah, look, it's fair to say the overarching theme of what we've been doing is really just to maintain cool, calm heads. I think that's the most important thing. Quite fortunate to go into this period well set up to begin with. So one of the benefits of being in high quality businesses is that they tend to be quite resilient to a lot of the macro shocks. So that gave us, a decent level of cushioning to enter into the episode. But, where we are now, it's a very fast-moving landscape, so it's difficult to make a lot of predictions as to how things are going to shape up. So we've been making some small changes around the edges, certainly not panicking, and then just sort of waiting to see how it all unfolds from here, really, because I think, we go one of two ways. Either this is the end of it, the uncertainty around the tariffs are resolved, and we avoid a recession and sort of things start to grind back up higher again. All this uncertainty around tariffs and what that means, et cetera, shakes confidence and, fundamentals like spending and CapEx down to a level where we start to see a recession, in which case there's more pain to come. So, trying to make a call at this point in time, one way or the other, I think is a bit, premature. So, we're sort of taking a wait and see approach. But like I said, very fortunate to have a well-positioned portfolio coming into it. So not requiring to do a whole lot of reactive changes on the fly as things were developing.
Yeah, I think that's the key, Lucas. Like the second half of last year, we trimmed high PE stocks.
Yes.
Very high PE stocks, because we noticed like 70 or 80% of our top 20 names were up between 20 to 40% just on PE expansion. So like that's something you got to be aware of. So we started to trim high quality PE names, tech names, and US industrials, which had really high PE expansion. So we trimmed a lot of that. So that's why we haven't done a lot actually now. Also, we're not massively exposed to things that are like manufacturing as well. So like there's certain sectors where there was high exposures.
Yeah.
But trimming down tech and trimming down really high PE has put us in a good position that we kind of had done by maybe August of last year.
Yeah.
Most of it had been done. So that's why we haven't really panicked. But I think, like Maroon said, it's keeping a cool head. What happens in this market is your high PE, high quality, high momentum stocks tend to come off really quickly. Defensives, gold, real estate, Utes, low beta and value does well. So we've started tilting towards those the last 6 months, and also tilting away from the US to Europe, where the valuations are a lot more appealing. They're the natural things that we've done together the last 6 to 9 months. And that's really a function of what we've seen, but also what the analysts are saying as well.
Well, also, I think it's interesting because it's really a testament to the investment process. I mean, there's always art and science, but the process and being familiar with your process, obviously there's an element of investing in quality companies.
Yes.
There's an element of investing in that
Value
valuation
as well.
part of the market.
Yeah.
As well as some others, but
So
having that discipline, it's quite interesting.
Yeah,
to
well,
see
as
it play
people know,
out.
our QVTM strategy, like quality was pushing over 50%, and those quality stocks had really high PE expansion in the last 6 months, 12 months to sometimes 24 months, 2 years of PE expansion. So when that quality is pushing 50, we know that we're at the point where quality has given us a lot of alpha, which it had, but that maybe needs to be retested and checked again.
Yeah,
so that's why we started to drift towards more value.
Yeah, no, interesting. And just on tariffs, I mean, you sort of touched on it briefly in some of your comments, but Obviously, that the tariff policy in terms of the US is undertaking is very fluid at the moment. It seems that every day it's changing, it's shifting, the narrative shifting, which is adding to the volatility, and the market's reacting to that. From a bottom-up perspective, from the companies that you hold, and also when you're obviously active in meeting with companies, speaking to the analysts, broad analyst team within Fidelity, what are some of the initial observations you're seeing in terms of how are companies reacting, and what are potentially some of the impacts on the companies that you hold within your portfolio?
Yeah, for us, again, fortunately, there hasn't been a huge amount of impact. The US industrials that we hold do a lot more of the manufacturing in the US anyway, and they distribute within the US. So they're not super reliant on importing things from particularly China. And, what we've seen is a rollback on all the tariffs apart from China. So even those companies that had 4 or 5 years ago, either through COVID or through the increasing geopolitical tensions between the US and China, had started to move some production away from China into places like Vietnam or India. Having the tariffs in those jurisdictions come down to 10% still makes those manufacturing hubs viable. So there hasn't been a huge amount of impact for us in that respect. But I think, companies that are heavily reliant on importing from China, they're going to have to very quickly reorientate their entire supply chain and sort of figure out whether they can bring the manufacturing back home, and if they've got the right skill set and the money to do so, if they need to go to a different jurisdiction and do that. But yeah, so there's quite a bit there, but thankfully for us, not a huge amount within our portfolio. So a lot of the companies that we hold haven't really been panicking or doing a whole lot in reaction to this.
Yeah.
I'll just maybe add the comment of US exceptionalism is over. I like that really high return in the US market is something that's been talked about for the last sort of 6 months. Now, when you look at it, the US is still the highest return on capital market that we have in the world. So that you can't, the tariffs has sort of tainted and supported that view that it's the end of US exceptionalism. But the reality is, for now and the next couple of years, the US market is still very attractive in terms of returns on capital. So yeah, what Maroon said is right. Like we haven't had a huge impact in the portfolio. And the US, we are reducing our weight, but the US return on capital as a marketplace is still very attractive. So that's what remains.
Yeah, because I think that's been an interesting sort of observation, is that you have seen a bit of that narrative, particularly in the media, where they've sort of this end of US exceptionalism, that you're getting, you might get this rotation into Europe or maybe other geographical areas, but you're sort of saying that actually net, when you look at the sort of all the bits and pieces, the US is still an attractive investment destination.
From the fundamental perspective, absolutely. Now, whether it remains the most attractive destination of capital, that's a different that's a different argument altogether. But in terms of the strength of the underlying companies, it's still by far the most attractive market from a return on invested capital perspective, profit margins, all those sorts of things. Still stands out quite attractively.
Yeah, so it is really about picking those individual companies with those characteristics. Now, if you sort of think about the US market, it's been fascinating because, year to date, if you look at the performance of the US market, S&P 500 is down circa 12%. But then within that, if you look at some of the performance of particularly some of these high-profile Mag 7 stocks, like an NVIDIA, for example, is year to date down around 30%, I believe it is. So, those sort of golden childs over the last couple of years which have really driven the market performance of the US have come off quite heavily. Out of interest, how has that mid-cap part of the market fared in this environment? Because again, there'll be a lot of people thinking, historically those big mega cap names are the safe havens. You get the small caps that sell off and maybe the mid caps. But what have we seen in this period?
Yeah, you go, Maroon. You've written a paper on this one. So.
Yeah, so it's been surprising, but the mid-cap space has actually held up quite well and fallen a lot less than the Mag 7 names. And it's a very unique sell-off because, as you mentioned, normally in a typical recession is here type sell-off, there's a flight to quality and the larger companies with typically stronger balance sheets and stickier revenue streams and more diverse revenue streams tend to be the areas that investors gravitate towards, and they tend to hold up a little bit better. And as you move down the cap spectrum, typically you see businesses that are a bit more cyclically exposed, higher beta, perhaps don't have the same balance sheet strength, so they tend to suffer a lot more. This particular sell-off is very different to that. And the Mag 7 has sort of been hit by a double whammy because if you sort of go back and, it feels like a lifetime ago now, but you go back to January or February, and the first wave was really DeepSeek, which, is so far in the rearview mirror now. But, that was the first wave because up until that point, the narrative had been that, the US Mag 7 pretty much had a monopoly on AI. And then DeepSeek came along and sort of changed that narrative. And so that was the first round where their share prices, got impacted quite significantly. And then you sort of roll forward into the last month or so, a lot more issues around, the geopolitics of things. And because the US runs trade deficits with a lot of countries around the world, how can other countries reciprocate? And there's discussions, could they tax some of these Mag 7 names, impose effectively, what the US are doing, a tariff, but impose it on services. Also a narrative around if the US want to shore up government finances, are they going to close some of these tax loopholes for some of these Mag 7 names who, given their size, are able to move money around to different low tax jurisdictions and, not pay the highest marginal tax rate. Some of these things are starting to impact, I think, Mag 7. And so what you're seeing is definitely a challenge to the narrative. The other thing as well in hindsight was we found out because these foreign investors, places like China, Japan, et cetera, have been running large trade surpluses with the US, they've been recycling money back into US assets. And so that's either been treasuries or what appears to be the case over the last 4 or 5 years has been US stocks. Now, if the US is really serious about cutting back some of the trade deficits it runs with some of these countries, perhaps they don't need to hold anywhere near as much by way of US dollar assets. And so, we've seen treasuries sell off. We've also seen some of the Mag 7 names sell off. So perhaps there's also a bit of flow repositioning taking place there. So it's multifaceted, but what it has meant is basically the Mag 7 and the top end of town hasn't fared as well as, you sort of move into the mid-cap space. And they're also global in nature, so it's hard for them to avoid any tariff impacts or tit for tat, whereas the mid-cap names, if they're sort of domestically focused, they can sidestep a lot of the collateral damage. So it's been a very unusual sell-off in that regard.
It sort of feels counterintuitive. But I guess the other point, and I correct me if I'm wrong, but I recall a little while you saying that the mid-cap part of the market, in terms of valuations, sort of have been trading within sort of 30-year averages.
Yes, absolutely.
So not rich in terms of pricing, whereas some of those mega cap names you could argue are sort of price for perfection. So anything if the market got the wobbles, well,
that's right.
So it's an interesting dynamic as well there.
So that's right. If you sort of went back to February, the MSCI World was trading at probably in its top 10 percentile trading range over the past 30 years. The only time it eclipsed that was the COVID scenario where you had rates basically go to zero. Whereas the MSCI World Midcap, which is sort of our universe, is in February was trading, right in line with 30-year averages. So the starting point in terms of how much stocks could sell off, you were already starting off at a much lower point.
No, it's interesting. Good point. James, anything from you?
Just add the momentum thematics as well as that big tech thematic. Momentum thematics generally. So data centers came off hugely. Vertiv's in our universe, and that one's fallen a long way. But also anything that's kind of energy related into AI has also come off quite a lot. So those... And also loss-making tech. So not only quality has moved down in terms of multiples, but momentum stocks and momentum thematics have also come down because when the market, like the last 2 years, the market was very confident, risk was very cheap. There was not a lot of attitude or pricing for risk. So that has really come out because risk has come into the market. People's duration was very long. Now it's come to shorter because people are more concerned about economic recovery. So they go shorter duration. And so that means momentum just doesn't work as well as a thematic. So things like your data centers, energy related to AI, all those things have started to also slow down in terms of multiple expansion or go the opposite way. So that's been a big thing that's also related to that kind of similar thematic.
So if we sort of look on a forward-looking basis, I guess, in terms of no doubt there'll be more volatility maybe to come with more tariff news as we sort of move into the second half of the year. But I guess thinking about some of the things you're focused on beyond the tariffs, what are the key things you're focusing on, but also opportunities, because I think, when you get market dislocations, and again, this comes with experience, and obviously you both of you have been in the markets for a while, market dislocations can be an interesting period for investment opportunities as well. So really interested to sort of explore what are the key things you're focusing on, and are there sort of opportunities that you think may pop up particularly if some of these quality names, if you do see them pull back a bit more, is there an opportunity there to pick up assets?
Yeah, we definitely are looking. Do you want to go
you
first?
Go, you go.
I made a comment earlier on about whether we morph into a recession or not, because I think that really is
key.
That is the key.
Yeah.
We're sort of at a point in time now where a lot of the soft data, so surveys, consumer sentiment, business capex expectations, they're all quite soft. They tend to lead the hard data, which is the actual numbers, but they don't always give you a perfect reflection. So in 2022, when the market sold off, we saw the soft data come down quite substantially, but the hard data held up. And so we avoided the recession.
Yeah.
Where we are now, we're seeing the soft data coming off quite substantially. Now, whether that's a repeat of 22 and we don't get a recession, if that's the case, then we're probably somewhere towards the bottom. But if it starts to morph into something more sinister, so if you start to see businesses delaying investment plans or laying off workers because they need to cover their tariff costs or anything like that, and that starts to feed into like a wage price spiral where people get laid off, they spend less, they start to fall back on their mortgage repayments and it impacts the entire economy. Because if you look at the average magnitude of a recessionary bear market, normally recessionary bear markets are typically down sort of 30 to 35% on average, peak to trough. And we've only seen peak to trough somewhere around the 18 to 20% mark. So if we do morph into a recession, we're probably only halfway through what we could typically experience. So we really need to remain vigilant, I think, for the next few months and understand whether the uncertainty remains contained or whether it's actually developing into something worse than that. And if you do get a recession, then it's likely to be towards the second half of the year.
Yeah.
So that, I think, really is that, you're sort of at this critical juncture. You could go down two paths. You're at this fork in the road and you just sort of need to make a decision. But we just sort of need to figure out exactly, how things are developing over the next month to 3 months, I guess.
And what are some of the hard, like for the listeners, in terms of, you mentioned hard data. So what are some examples of that and what are the key ones you'd be looking at?
The key one would probably be employment numbers because if you remain employed, you maintain an income, then you can continue to spend, you can continue to service your mortgage, et cetera, et cetera. Once that starts to disappear, you spend less, you fall back on your mortgage repayments, your spending is impacting that business's revenues, which then has to do another round of layoffs. So that's how it all ripples throughout the entire economy. So really the key thing is looking at the employment numbers because once that domino falls, the rest typically
follows.
Quite quickly afterwards. So if you had to distill it down into one thing to look at, it would be the either employment numbers or unemployment rate in the US. But looking at a broad range of things, basically assessing things like consumer spending, GDP, although it's quite lagging, but things like GDP growth, et cetera, they would be the key. So, and then, in terms of opportunities, to sort of wrap it up, because what you don't want to do is find opportunities in cyclically exposed names, which look quite attractive now from a valuation perspective, and you start to invest in those, and then you get the recession come, and that second leg down impacts those companies disproportionately. So that's sort of why getting the answer to that first question is really important, because then it can give you a good guide in terms of what areas to narrow your focus on in terms of where to invest going forward.
Yeah.
And whether you go more defensive or whether you start to add risk back on into the portfolio is really determined by that single question.
But it feels like, from what you're saying, it feels like both of you in terms of the portfolio have made a couple of conscious moves before this whole thing happened, right? So it feels like you've got a bit of room to move should opportunities or should the market environment change.
We're kind of sitting and waiting, like Maroon said, for now.
Yeah.
Until we're have more certainty over what the year or two is going to look like. So we're looking at quality stocks that have fallen because valuations are more attractive.
Yeah.
Cyclicals, we're probably holding off for a little bit more. And then you've got to be careful of where your leverage or exposures are. So into consumer leverage, you've got to be careful. Market leverage, like equity market leverage, you've got to be careful. And cyclical leverage, you've got to be careful.
Right.
So if your exposures are in those three areas, which if the recession or even economic weakness starts occurring or becoming a bigger mindset for the market, sentiment will shift, multiples will shift down lower. And you need to be careful of that. So we're really, kind of in wait and see mode at the moment, but there is opportunities that are out there, but you want to make sure that you're moving in one direction, not having to chop and change.
Yeah.
And that's what experience tells you. You don't want to go too far down in terms of being defensive, but also you don't want to also jump in too early when you're not as confident, or you
Yeah.
don't have the data to give you the confidence,
Yeah.
which will give you visibility and therefore ability to think longer duration.
Yeah.
So that's
yeah.
what we're kind of in that stage now.
Yeah, no, that's really pertinent because I think there's a lot of investors out there that, if you look at some of the other recent market pullbacks, it's been, pretty much a matter of let's just buy the dip,
Buy the
and
dip.
the market
Yeah.
sort of, but
Yeah.
it feels like there's a lot more complexity in terms of what we're
Yeah,
seeing.
and you've got to remember what we've just gone through. High
Yeah,
inflation,
yeah.
right? Low price of risk. Now we're going into an economic concern.
Yeah.
Inflation's coming down. Rates are maybe going down.
Uh-huh.
So we're still in an environment which is a little bit more uncertain than it
Uh-huh.
has been. So you need some time for that to clear.
Yeah, perfect. All right, gentlemen. Well, thank you for that. That was very insightful and I think very timely given that there's a lot happening in
Yeah, a lot
markets,
going
but really interesting insight in terms of how to navigate that volatile period. So thank you.
Thank you.
Yeah, thank you. It's great.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Fill Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.